Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, August 15th, 2024, and today's episode will start by mentioning the initial jobless claims came in yet again lower than expected. If you remember the last reading of this, it was expected to be much higher than 233,000, and then the expectation for this week was actually just 1,000 higher than that, which is still pretty low, and it actually dropped again to 227,000. Now remember, this is how many people are filing for jobless claims, the initial jobless claims filing. And so this is going down. So according to this metric on a weekly basis, people are finding, the work that they're not losing their jobs, rather. So at a higher and higher rate. And so the effect of this, along with retail sales apparently being very strong, in other words, people are still buying stuff, getting more debt on their credit cards is part of this too, by the way. But however you want to look at it, markets, they really broke higher today. This wasn't like a friendly day up. This was a break higher, and we'll take a look at the charts soon. Just as a daily reminder, 2-year, 10-year yield curve inversion is still past its second birthday. This is extreme. This is not good. This says that we're headed possibly into a depression, but who cares? The markets break higher here. Also, the SOM rule was triggered. The SOM rule being that the official unemployment rate, the percentage of people that want work that can't get it, is going up in like a straight line, and that's a bad thing according to the amount that it's been going up, even though it's still sort of low. That's what triggers this SOM rule, and according to that metric, we are actually already in a recession. The way I look at it, dumb money is piling in here, and people are taking advantage of that, and I think people are going to take more advantage of that when we go the other way. It's just me and my crystal ball, but if we zoom out to this is a daily chart of the S&P 500 SPX. The beginning of this chart starts in August of 2023. If you take this high here, connect it to this high and this high, very interesting how we bump along this exact line here 3 times. It's amazing how these trend lines end up playing out in real life. And then on the downside from this low, we have a low here and then a low here, and then we broke through it. A lot of people were seeing this break as being like it, and that we might retest this line here and go further down. Now, the game's not over, but for now, we actually broke back above this line. And so, depending on the time frame that you look at, weekly or monthly, you could potentially, especially tomorrow's Friday, it's the end of the week, right? So if we close above this line here, it's just bullish. There's no other way to put it. It wants to go up. People want to keep buying stocks here. I highly believe that this could be a fake out here. When you have one candle go above a line like this, it's very common for it to go right back down below it the next day, and that would actually confirm a bearish look. So really, there's a lot of weight on tomorrow's market movement, in my opinion, as to whether it really looks more bullish or bearish here. But no matter how you look at it, from looking at just today, man, does that look bullish. I mean, there's just no other way of looking at it. I mentioned Gareth Soloway talking about we were in a triangle of death here, and how he thought that, he was pretty confident actually that we were gonna go the other way from here, and we are out of it to the upside. So that pattern failed, and we are now, like I'm saying, on the daily time frame, it's looking bullish as can be. I'm certainly nowhere near even thinking about going long here. Again, with the cuts coming, with the PE ratios, with the inverted yield curve about to uninvert after the longest period of yield curve inversion pretty much ever, the Somme rules triggered. We're headed into a bear market. I can say with certainty, with strong certainty at this point. But that's just me and my crystal ball. The retailers are in the driver's seat today, obviously, driving this higher. By the way that I look at it, on a weekly time frame, formidable red candle here for the week. Again, tomorrow really I think could end up even being one of these days where things crack the other way and just plummet just out of nowhere. It'll be interesting to see how this plays out. Again, the VIX went even lower today than yesterday. I talked about how the VIX looked like very juicy here. Gareth Soloway thought it was a good time to get some exposure to the VIX itself, that maybe it'll be going up from here. I do have calls on UVXY that would benefit from a large move. Again, this is like a tiny amount of my portfolio, but if this thing blows up, the amount of leverage options contracts have, you can increase your entire portfolio size by a very large percentage compared to the percentage that you use to buy those option contracts. It's amazing how leverage can help you out in expected volatile times, especially as volatility is getting cheaper right now, and you expect more volatility ahead, as I do, I'm not the only one out there that does, but anyway, I digress again. HYG, high yield corporate, junk bonds, higher today. They went higher today, while TLT actually dropped in price today, suggesting that credit spreads have gotten tighter today. So, just recently we thought we were falling apart here, and the credit spreads were finally it's almost like a sigh of relief that credit spreads are normalizing, that they're separating a little bit more, that people aren't, sitting on higher risk compared to the amount of yield that they can get from their investments. This is, from my perspective, this is scary as heck. The roller coaster, in one way to look at it, that I kind of imagine it is, to me, how it feels right now anyway, is like a roller coaster that's just been going up and up and up, and now we're going way higher than anyone expected, and I think the ride down is going to be pretty insane pretty soon, very, very soon, in my estimation. But I'm just a guy with a crystal ball, so whatever, don't listen to me. TLT forming what looks like a pretty orderly bull flag here, the way I see it. So again, it is my personal belief this is the driest, most unloved, undervalued asset class out there at the moment. VIX futures curve, again, the further out these contracts go, the higher it's supposed to be, because time costs money. However, October is still highly elevated. It's still elevated today, above through January's contract, but now below the February and March. But just look at this curve here. The market is still expecting a massive surge in volatility going into September and October, as I do myself. I guess, one of the problems with this is that when everybody expects the same thing, a lot of times the opposite happens. It's the everybody on one side of the ship kind of thing. If everybody goes to one side of the ship, that side, because they think it's going to go up, well, actually, that side ends up always going down and the other side goes up. So, who knows? Maybe the stock market melt up could go even higher before the eventual dive down, but we'll see. Interestingly, the September meeting went from a probability of one cut from 64% up to 75%, along with the market rallying here. So again, interesting that there is less of a chance of 2 cuts, which would normally be bullish because that's cheaper borrowing money. So we have actually, this is a tighter condition expected while the stock prices are going up here. It just showing how, I mean, what does that say? It says that people believe that the economy is very, very resilient right now, and that things are very strong, and that there aren't any problems here. That's what the market is saying right now. And I think it's gaining a lot of confidence, and I think it's killing a lot of bears. And like I've been saying in many shows, a lot of times, you know, you kind of need to kill all the bears before the market actually gets bearish. And I think we're basically there. You know, it's funny. Sometimes I'm looking at these charts and I'm feeling it. I'm feeling the FOMO being like, hey, maybe it's time for me to just jump into VU for a little bit and ride it the rest of the way up, you know, and then maybe do a trailing stop loss or something. But the fact that this is the first time I've felt that this way in a long time tells me that it's probably exactly the wrong thing. You know, while my feelings are telling me, yeah, this is it. You know, even with all the stuff that I know and think, it tells me that maybe this is really it. This is really the top here where things will fall over. I'm more confident about it. The more I feel the FOMO of the market going up at this point in time, the more confident I am actually in my head that we are going the other way. But again, me and my crystal ball. All right. Yeah, again, you know, I talked about yesterday how it's been very clear that we were looking at 2 rate cuts between the next meeting in September and or 3, sorry, total for September plus November. But now we're actually only seeing 2. So we're seeing a more orderly cuts priced in right here. And the idea, obviously, behind the markets here is that everything's fine. The Fed doesn't need to go into freak out mode. Nothing's in freak out mode. The market's not collapsing. Everything's fine, except for the fact that it's like, it's too fine. Like, credit spreads being this tight is abnormal. It's not normal. This is when markets get dumb. This is when people get really dumb and do things they shouldn't be doing. And I hope to benefit from that, from my own positioning, and mostly with treasury bonds. I'm like 55% in various leveraged versions of TLT, basically. One last chart I want to bring up is wood. How, you know, this is a good leading indicator. This is certainly not showing as much strength as the S&P 500 if you consider S&P 500 to be kind of dumber money than wood. Wood is a great leading indicator I like to follow to see what's going on. It's not convinced. We had a pop here today, but we're not like in any kind of bullish looking pattern or anything like that. If anything, it looks more like a bear flag that's pretty destined to be heading lower from here. That's all for today's show. Hope you enjoyed. Thank you for watching. Rob's Child.